Welcome to Bloomberg Markets. I'm Shonali Basak. We're going to bring you in with a check on these markets in the green today. Thank you, Netflix. Better on earnings there than analysts expected, and you're seeing it in the tech stocks. That NASDAQ 100 above that $20,000 level firmly at a 0.5% higher today. That is at 20,300 nearly. S&P 500 up about 0.3% as well. The 10-year yield is interesting. Bit of a bid there in the bond market, but only to the tune of about 2 basis points. But we were hitting 4.1% earlier this week. We are now closer to 4.07. Also watching New York crude because, of course, that has been fluctuating this week, but we are below 70. A little bit of the foot off the fear pedal there when it comes to geopolitical tensions as well, down about 1.2%. We're going to also bring you some midday movers on the equity side. We have for that Bloomberg's Abigail Doolittle.
Well, here's that Netflix you were just talking about, Shonali. Right now up about 10% on the day. A great day for the stock. This after the company did, of course, beat top and bottom line estimates. Margin growth was great, but it was really the subscriber beat that investors were very excited about. More than 5 million people were subscribers in the last quarter. Some analysts saying that it was just the perfect balance. Investors seem to agree, up 9.9%. To the downside, though, we do have the shares of CVS, and there's a combination of factors here that are driving the shares lower. In fact, it is the worst day since May of this year. Right now, down 8.1%, pretty close to the lows. So they pre-announced to the downside. They put out preliminary numbers. The profit missed. They also suspended the full year guide, and the big headline, they replaced the CEO. So this beleaguered drug retailer, pharmacy, insurer, well, they're having issues, and investors clearly sending this stock lower yet again. And then finally, to end on a bright spot, Lamb Weston, the frozen potato company, it's up 9.3%. JANA Partners today said that they have a 5% stake, that they think they really can get more value out of it as an activist shareholder. Investors seem to think that that's possible at the high. Shonali, the stock had been up 11.5%. That was the best day since November 2020. Right now, the best day since January 2023. Not so shabby.
Investors seem to like it. Abigail Doolittle, we thank you for looking under the hood. We're going to stick with activism because it has been a stunning year, and we are joined now by Head of Shareholder Advisory at Consello Financial, Kiran Murthy. When you look at what's happening with Lamb Weston, what is different or similar to what you've been seeing this year? We've been seeing so many companies really face a lot of pressure from activist shareholders. Is it all for similar reasons?
Good question. I mean, if you look at the last 15 years of activism, there was a bull market shareholder activism. It was focused on M&A thematic up until, call it 2 years ago. The last 2 years, without a broad-based M&A recovery, a lot of the focus on operational elements. And that operational elements generally has a change in CEO or board. So what you guys mentioned, the Pfizer, the Starbucks, the CVS Health, or the Southwest, there's a focus around if companies aren't able to fix up their operationals, their costs, and cash flows, there's a specific focus around the CEOs. Second component that I would say is there's a lot more private engagement. So for every public situation that we see in the media, there's probably 4 or 5 private situations that there's engagement with investors.
I was just about to ask that because you have seen such a stunning amount of CEO turnover this year. And you have to wonder, is somebody knocking at the door at those companies?
Listen, by our estimate, there's 1 in 4 companies in the S&P 500 has an activist investor in the top 20 shareholder registry. So you can imagine there's a lot of private engagement across that. But what's really changed is not just the activists, but it's the broader investor mindset, right? So Glenn New, for example, initially came out with CVS, and they put out an NDA today that focused around their accepting of the new CEO change. They're not an activist investor. The aspect of traditional long-only investors willing to be private has meant that there's a lot more engagement across that community.
It's interesting, too, if you could pull up the stock of CBS at some point as well. You really did see a huge reaction today with the CEO stepping down. And to your point, they had an activist in the stock. What does that conversation look like in the background? If you advise a lot of companies, if you are a company privately engaging with a shareholder, at what point does that shareholder say, I'm not getting enough out of this conversation, I'm going to take this campaign public?
Yesteryear campaigns were a lot more public. So if you look at most of the flagship activists of yesteryear, it's Carl Icahns, the Bill Ackmans, the Dan Loebs, et cetera, of the world. They had to be public to be able to foster change. Today, most of the conversations are private. Generally, when there's a difference between the company's plan, the company's expectations of the plan versus an activist, that's when it trips into public arena. But the name of the game is, share price performance and outlook, right? So most of the activist campaigns this year has been at companies where there's significant underperformance compared to the market or the peers. And activists said, this is a great risk-reward trade for them to take a stake in.
You know, it's interesting. CVS was a great example of a company where there has been management change, like many others. Lamb Weston, something interesting about it was it reportedly has an M&A element here, that JANA wants a sale. Are you seeing more and more M&A situations with these activist investors?
Historically, 2/3 of all campaigns had some sort of strategic alternative bent that meant. What that means is for large conglomerates, spin off or break up the businesses. For mid-caps in an era when rates were very low, private equity had an enormous amount of dry powder, it was easy to catalyze sales across the mid-cap and capture some sort of premium. Today, that's no longer the case just because the last couple of years. It's much more focused on operational element because that M&A trade is no longer there. We anticipate in the next 12 months or so, with rates coming down, the certainty post-election, we anticipate more private equity looking to transact, and activists are oftentimes early movers in those campaigns.
What do you mean by that exactly? Because interestingly enough, you know, when you're thinking about M&A, you think about large company acquisitions.
Yeah.
I think CVS, sorry to keep bringing it up, but it is a poster child example about some company that absorbed another company that was very large and now might have to look at a breakup once again. Are more of these M&As now focused on spin-offs that might go into private equity hands rather than large acquisitions or sales?
Absolutely. You look at the equity markets at all-time highs, right? So for a spin-off, you don't need that buyer, you don't need financing considerations. And most times investors are saying, I can have two pieces of paper that have different end markets and let me do the diversification. I don't need to the company do the diversification. It's, you know, there's a little bit of the build them up and break them apart thematic with large conglomerates. But for activists, if you look at the returns that they've generated, and you bifurcate the holdings across those activists that are much more focused on strategic alternatives or M&A versus those that are operationally inclined, the ones that are able to catalyze an M&A transaction have far outperformed their benchmark.
You know, what are the kinds of activists you're seeing out there? Because you kind of were always afraid of Elliott around the corner if you were a large corporation, and now it seems like there could be an activist at every corner. There are many more out there.
Absolutely. I mean, I referenced that there's 1 in 4 companies in the S&P 500 by our estimate that has an activist in their registry in the top 20 active holders.
But is this kind of like those traditional activist hedge funds, or is it, you know, BlackRock or another kind of organization that is just fighting for change?
There's 3 kind of elements to it. There's the core flagship activists, so let's put the Elliott and the Ackmans in that kind of camp, and the icons. There's a spin-off funds. Because of activists have become some of the best performing asset class amongst the buy-side community, Elliott, for example, the former portfolio managers have launched a dozen or so funds in a tough fundraising environment. What that means is there's just a large quantity of them. And second thing that tells me is that they need to establish themselves. So they need to get wins on the board, either through public campaigns or most importantly through returns. And if you look across the market, when I speak with activist investors, one thing they tell me is that it's a difficult environment to be a stock picker, right? Markets are all-time high. 3 out of 4 companies in the S&P 500 are within 10% of their all-time of their 52-week high, and you throw in election uncertainty, strong earnings tailwind across most of those companies. It's very difficult to say I have a plan B that's different than what the company's doing. So hence, they're focusing solely on some of these what we call the TSR laggers, or the fallen angels, and say, can we maneuver something around the hoop across those names?
And I just took a quick look at Bloomberg data while you were speaking as well, and you are absolutely right. Activist hedge funds are up double digits this year. It's almost 14% in the past 1 year. And so, you know, you were mentioning private equity as well, saying that they're part of the story. Elaborate on that a little more.
Sure. We've often seen, I speak with activists, that at some point private equity has to start transacting. You know, the continuation funds or the dividend recap can only participate for so long a period of time. At some point, they're paid to buy and sell assets. And activists don't often do this, but what I call soft catalysts. Hard catalysts are event-driven funds that post an M&A transaction, they'll take the trade on going long or short, that acquire the buyer. Soft catalysts are select activists that are saying, listen, when the M&A market opens up and private equity is going to be early buyers, this is an attractive entry point for me to take a stake and to potentially catalyze a sale at some point in the next year. And I think that's going to be the biggest backdrop across mid-cap public company situations where...
So basically they're forcing private equity firms to sell faster.
Or buy into mid-cap names.
Absolutely fascinating. Anyways, that is shareholder advisory head at Consello Financial. We thank you very much for joining us here in studio. Of course, very relevant day to speak to you. That is Kiran Murthy. Now, coming up, we're going to talk about Ally Financial falling in today's session. The auto lender is giving a pessimistic outlook. We're going to tell you why next. This is Bloomberg. This is Bloomberg Markets. I'm Sonali Basak. It's time now for the stock of the hour. Ally Financial lower after it reported earnings after a pessimistic outlook for loan charge-offs, and it had lowered its net interest margin forecast. We're going to be joined now by Bloomberg's Paige Smith, who covers the company very closely, all over everything that's happening in the world of credit. The strangeness to me is that they told people that the outlook was getting tougher. So why is the stock falling even more now?
They did. They certainly gave a very sort of stern warning, if you will, that this was coming. But, you know, when you look at really the change in the outlooks that we've predicted and sort of the detail that the lender went into in terms of ways that it was tightening that credit for consumers, I mean, it was certainly detailed. I'll put it that way. It was a lot for folks to chew on. I'll put it that way.
So the stock is only up about 1.3% this year. It's basically flat on the year. So, and it had been up pretty meaningfully. It had a lot of those losses more recently with those warnings. What is it about Ally? I mean, how does this compare to other type of lenders out there, and what does the consumer base really look like?
Ally is very macro sensitive. If you think about the U.S. consumer, it's, you know, there aren't as many lenders in today's day and age that really have such exposure to sort of the average man on the street. I mean, Ally is really heavy in auto lending. It's personal loans. It's like quite a good picture into the U.S. consumer and sort of the U.S. consumer and kind of the middle class or the lower end of things.
So, and that's kind of what I was going to ask. Is this more about this being kind of lower and middle income consumers or about the auto industry?
I think that's a good question. I would say that what they did say was that they're tightening their credit, that they're extending to folks who are looking to buy a new car or a used car for that matter. So it's looking at things like pulling back on those high monthly payments that consumers have gotten more used to, or consumers that walk in and maybe have a higher debt to income ratio might not be as likely to walk off the lot with a car that day.
It's interesting. When you take a look, you actually also had American Express reporting earnings. American Express is known for a much higher income consumer. Anyone with a gold or platinum card would know, but yet you do see the stock down today. What are the issues that investors are seeing happening over there? They were very positive about their look into the future.
So they were positive. They did slightly tweak their outlook for net revenue for the full year. So that range was supposed to be 9 to 11%. Now it's around 9%. I would say, too, though, they also raised components of their outlook. But as you said, it is kind of the tale of two consumers between these two companies today. When you look at Amex, they highlighted things like diners continuing to spend and travel and, you know, turn to those really expensive cards that we all know and love, but also you have Ally, which really is kind of more of a picture into the subprime consumer.
I would say it's interesting because they were talking a lot about marketing spend, and you have to wonder if where we are right now is you have to spend more to get that extra consumer. You know, you have a lot more earnings coming up. What else are you going to be looking at this season when it comes to credit quality, and what companies?
I am very fascinated to see kind of spending volumes among Visa and MasterCard, which are upcoming earnings. That is just kind of an overall indication of how consumers across the board are continuing to spend. If there's any weakness in those folks, that'll be a pretty good bellwether. But, you know, we'll also have to see if there are some other consumer-facing companies still to report. So we will watch closely to see how the consumer is faring.
Paige, we thank you so very much for reporting. I know it's been a very long day and still a long day ahead for you. That is Bloomberg's Paige Smith. Now, coming up, markets are betting on the election, and the odds are starting to sway in one candidate's favor. But there is a little bit of controversy in those numbers. We're going to have the latest on that next. This is Bloomberg. This is Bloomberg Markets. I'm Sonali Basak. We are going to turn our attention to Millennium Management. It aimed to raise as much as $10 billion of new capital for its hedge fund, and it turns out investors wanted to fork over twice that amount. For details, we're going to be joined now by Bloomberg's Hema Parmar, all over the hedge fund industry for us. Millennium, of course, is one of the top multi-strat hedge funds. That's a lot of money. How did $20 billion worth of new demand come in?
Yes, this is an incredible amount of demand to have, size of some hedge funds alone. And Millennium is a firm that's known for being pretty reliable. They have had steady returns since their inception. They've only had one down year since 1989. And when they were down 3% in 2008 when markets were doing far worse.
And it's interesting, you guys had reported also, Kathy Burton said that they're up about 9.5% this year through the end of September. It's interesting, I had a conversation a couple of days ago with Ted Pick, CEO of Morgan Stanley. I asked if these kind of firms are over-levered. He said actually the multi-strats are doing okay. They're near historical averages. I'm wondering about, how much more these firms can keep going. What does this new cash help them do?
Yes, so this cash is raised in an interesting way. It's essentially a drawdown structure. And what that means is it gives them a cushion of money that they can tap whenever they want to. And so it gives them more reliability. It takes the uncertainty out of fundraising. It means they're less likely to just sit on investor money because they can call it when they want and use it when they want to. And, it's where sort of the industry has been locking up money for longer and longer. And because of the structure, it gives them more stability.
Well, it's interesting. I'm glad you brought up that locking up money point because, you think about Citadel, for example, probably the biggest of the competitors. And I've had people tell me, well, Ken Griffin doesn't need to court any money ever, really. They're not really looking for new money. How does Millennium at this juncture compare with what else you're seeing in the multi-strat world?
Yeah, they fit very well into a lot of the trends that we're seeing with these giants. Millennium now runs almost $70 billion. These are huge funds. These are firms that have doubled or tripled their assets in the past 5 years alone. And so the balance of power has shifted, and so you're seeing the firms being able to demand more preferential terms, so locking up capital more, so doing a drawdown fund that lets them have this cushion of money that they can use whenever they want to, as opposed to some firms where maybe the investor can dictate because of the hot demand and swell of assets. That's a very interesting trend.
Last question here, Hema, for you really quickly. What does this mean for potential future talent? Because we have seen a lot of interesting moves in this world when it comes to talent. Those pass-through fees have been controversial at best, but you see these funds having so much power in the market.
Yeah. So there's a hot talent war in multi-strats especially. You're seeing the cost of this talent go up. These efforts of locking in capital, firms would say, helps them retain their talent.
Employee capital, too, as you reported yesterday.
And it helps them retain their talent. So firms are employees are less likely to either jump ship if they know that the firm will be there for a long time.
A lot of lockups, locking up investor cash, locking up employees. Bloomberg, Hema Parmar, we thank you so much for your time and reporting. We're going to turn now to politics because we are 17 days away from Election Day. The markets are placing their bets. Earlier this week, I was able to talk to legendary investor, Duquesne Family Office Chair and CEO Stanley Druckenmiller. Here's what he had to say.
And I must say, in the last 12 days, the market and the inside of the market is very convinced Trump is going to win. You can see it in the bank stocks. You can see it in crypto. I would have to guess Trump is the favorite to win the election now, but who knows what these polls even mean? No one even responds to them anymore.
Now, I want to dig into the crypto part of what Druckenmiller had just said, because crypto-based prediction platform Polymarket shows Trump is the clear favorite to win the election. But some people are suspicious about what could be driving the trades on Polymarket. Bloomberg's Mike Regan has been following the story. He joins us now. What's with some of these trades? I mean, there has been some reporting around outsized trades.
Yeah, so this all started, some users on Twitter started noticing this about 2 weeks ago, and it's right when Polymarket really sort of mirrored the polls there for a long time. Kamala was slightly ahead, or it was a draw more or less. And then about 2 weeks ago, Trump really started putting up a wider and wider lead on Polymarket. And some sleuths on Twitter basically looked at all the data on the blockchain and discovered that there's basically 4 accounts that have bet super heavily on Trump to the tune of about 35 million as of today. The Wall Street Journal wrote about it today, and they've continued to bet even after that story came out. So there's a couple reasons why people are a bit skeptical about Polymarket as sort of information value for the election. For one, U.S. investors aren't supposed to be trading on it. I mean, there's probably some who are finding a way around it through VPNs or offshore accounts, but it's not really open to U.S. investors.
Can we double down on that aspect of it?
Yeah.
Because I think that's the most fascinating part. The way that stablecoins have been used to bet on this. I mean, can U.S. authorities not track who's on it?
So I think if they really could, if they really wanted to dig into it and figure it out, but all these accounts are anonymous, and so you don't really know who it is. But the other sort of reason to really be critical about it, too, is that this is a crypto-based betting platform. So the assumption is, again, we don't know exactly who's on it. The assumption is it's mostly males, and that, you know, crypto in general kind of skews heavily towards Trump supporters these days because he's been such a cheerleader for the industry. But the really big mystery is, okay, there's these 4 accounts that appear to have really moved the needle quite a bit. It's now something like, you know, most polls are either even or one candidate's ahead by a point, or the other's ahead by a point. Polymarket shows a 60-40 split between Trump and Kamala Harris. And remember, that's all based on the dollar value of what's being bet. It's not, it doesn't tell you that 60% of people are predicting Trump and 40% are predicting Kamala. It's telling you that the dollar amounts being bet skewed 60% to Trump and 40% to Kamala. And when you have 4 accounts that have bet 35 million and counting, it raises a lot of questions. You know, there's nothing as of the moment to indicate that this is being manipulated or there's anything shady going on. It could just be some Trump supporters who are betting big, but it certainly raises a lot of questions.
We'll keep an eye on it. I hope to cover it again soon. I'm sure the speculation is going crazy. Bloomberg's Mike Regan, we thank you so very much for your time. I'm Sonali Basak. That does it for Bloomberg Markets. Have a great Friday. It is an up arrow day ahead of another busy earnings season ahead. This is Bloomberg.